Ladies and gentlemen, Greg McCloskey from ForexLive.com. This is a Forex Quick Look. I'm going to take a look at the Aussie versus US dollar from a technical perspective. Today's date is June 20th, 2024. Let's get started. If I go back in time and put a red box around this area right through here, most of the price action over this time period, which encompasses around 6-7 weeks, has been between the 0.6575 level and 0.6589. That's only about 115 pips over that time period. Not a lot. Lots of ups and downs in between these two extremes. Now, at each of the extreme, there is a swing area where a number of different swing lows and swing highs came into play. And if you take a look at the price action this week, the low price came near the high of that lower swing area. And if you look at this week's highs, the high price came near the low of the higher swing area. So again, ahead of the extremes right here that define the red box, but still within the swing areas at either extreme. So we are seeing, support buyers come in at the lows, resistance sellers coming in at the highs, and that's what is helping to define the trading range for the week. Now, ultimately, if the price is going to go higher, we need to get above the 0.6989 level and stay above that level. Admittedly, looking back over this 6 or 7 weeks, there have been times where the price did extend above the upper end of this red box right through here, but each of the time the market failed. Conversely, on the downside, we did have times where the price did trade below this swing area, more specifically here, and I think we moved just a little bit below the level right here. But each of the time, the market failed as well. So what traders want to see ultimately is either a break to the upside where we go and take the high and move above that level, or a break below the lower end of the extreme, get below the 100-day moving average and get below the 200-day moving average, 50% retracement, and move to the downside. Obviously, we're not doing that. We're fine. We're trading the range. We're trading the ups and downs. We'll see how, so be aware of that. Be aware of that dynamic. Now, in between the extremes comes the 100 and 200 bar moving average on the 4-hour chart, and each of those moving averages are converged at the 0.66367. That happens when the price trades up and down in a narrow trading range for an extended period of time. Finally, all of those two moving averages came together and formed and are kissing each other right here in between the higher and lower extreme. This area will be a barometer for bullish above if it stays above, or bearish below if we move below. It's just the way it is. So buyers and sellers continue to battle it out between extremes in the Aussie versus US dollar. Ultimately, we're going to get a break. But until then, look to trade the trading ranges, leaning against the extremes, and using the two moving averages in between those extremes as period bias defining levels for both the bulls and buyers and the sellers. My name is Greg Michalowski. Good fortune with your trading. Bye-bye now.